Good evening from Money Matters TV. I'm Paul Sloate, CEO of Green Drake Partners, and with me tonight is Brian Kohute of HJ Wealth Management as my co-host. Good evening, Brian.
Good to see you, Paul.
Good to see you. So, with this strong economy, what's the Fed going to do?
They're going to taper eventually, right?
Yeah, eventually.
The big question is when, how much, obviously we don't time the show, but we're seeing the long-term interest rates start to creep up, which means it's coming.
It's coming. I mean, the market always is ahead of the Fed.
Yeah. What's your thought? I mean, with Yellen in, you think they'll do it sooner rather than later?
I think it's going to start in the first quarter.
Yeah.
So first quarter of 2014, the Fed begins to taper.
You think the market has a negative reaction to that, or?
Hard to know. A lot of it's been discounted in. I'm not sure that there'll be a negative reaction to tapering. But that's different. What the market's going to do may not really depend on what the Fed is doing right now.
Yeah. Wouldn't that be nice?
Wouldn't that be nice? Oh, yeah.
Yeah, I mean, like I said, we're seeing it in interest rates, right? So I think, those last minions that haven't refinanced need to get on it, which I'm not sure there's that many left, but if they haven't, they need to get out of their seat and do it, right?
So maybe we should talk about what the rise in long-term rates might mean for the economy.
Yeah, I mean, it conceptually should be good, right? Because the economy's doing well, and they're trying to slow it down by raising rates. There seems like this, I don't know, it seems like the market's overly fearful of rates going up, and I think we're all saying, well, it has to happen, right? They can't stay this low forever.
No, they can't. I mean, it's kind of, if they stay this low, it's because there's a problem in the economy.
Right.
So they need to go up.
Yeah, so I think we all say, we all want rates to go up. Probably not dramatically, quickly, right?
Just
over
gradually
time,
step up.
It would be good for the bondholders that need income, that don't have long-term bonds. It'd be good for everybody. I think the banks would be big beneficiaries of a steeper yield curve. So, so on the whole, it's good. I think it's really just a rate, how quick it happens, is probably the bigger issue out there. So.
Right. And probably the one area that may see a little bit of a slowdown is the one area that's been really hot the last 2 years, which is housing.
Housing, right. Yeah. I mean, you're definitely seeing it on the refinance side, right? But new homes is kind of picking up the slack for the refis, right?
Right.
So.
And even the home builders have indicated they've seen a slowdown in orders. So it's definitely going to impact them. And I also think part of their problem is they really push the price pedal too far, too fast.
Yeah, I mean, you've been pretty bullish on residential real estate. Are you still bullish on it?
Long term, I'm very bullish on residential real estate. Short term, last summer, and I'll define this for the show, people watching the show, which would be the summer of 2013, we turned neutral on housing because we felt there would be a short-term slowdown before it reaccelerated. Okay. So I think that the short-term slowdown is kind of right on track with what we expect. And we expect housing to reaccelerate late in 2014 going into 2015.
Okay, good. Well,
so you've got this little slowdown, and then you're going to see a reacceleration. And that, by the way, would be very similar to what happened in the 80s and the 90s, where we had these decelerations and reaccelerations in housing.
Okay, well, housing's good for the market and the economy.
It's really good for the market, and it's really good for the economy, so I agree.
Good.
So let's talk about the market. So the market's had a banner year, one of its best years ever.
Yep. Yeah, it's been a great year, mainly U.S., right? I mean, I think
correct.
We saw the Europe, which had struggled most of the year, finally come on. I guess the news was it's not as bad as people thought it was. So maybe put some money in there because there were some valuations. And I guess China, continues to get, painted with, can they continue to grow, right? And what are they going to do to keep growing? But we've always said, it's a lot of people growing pretty well. Right?
It's a lot of people. It's a command economy.
Right.
They can continue to grow when other economies would really slow.
Right. So there's a lot of speculation that China's in this major slowdown, and I know you don't see it. I don't see it. But that's
slow down from what?
Right. From 12 to 9 or
12, even 12 to 6 or 7
would
be really good, especially considering China is now the number 2 economy in the world.
Right.
So if the number 2 economy in the world is growing at 6 or 7%, that's a huge boost to global GDP.
Right. I mean, we're trying to scrape out for 2s and 3s, right? So
right.
That's pretty good. So yeah. So I don't know what your thoughts on Europe. Is the worst behind them? And
I think it's Europe is an it depends question. And I think what it depends on is what the European Central Bank does. Mm-hmm. Because if the Germans, who are in charge of the Bundesbank, continue to resist allowing the ECB to put money into the European economy the way the Fed's been doing here,
right,
then you could have a problem in Europe. Another problem. They've already had
they've had some.
They already had a double dip recession because of monetary mistakes. And you could have another monetary mistake. And I think the risk with Europe is if Europe doesn't get its economic act together, you could start to see a dissolution of the EU. People just start leaving because if I'm Greece or if I'm Spain or if I'm Italy, I might just be better off outside the EU.
Are you surprised no one's tried to leave it yet? Or
well, I think it's a time thing. If the economies can't recover enough over the next 2 years, I think there's a real risk that a major economy could leave. I mean, I think Greece is close to leaving now. And I think an economy like Spain or Italy, if there's no recovery as part of the EU, there'll be pressure for them to take a more nationalistic viewpoint and potentially leave the EU.
That makes sense.
So, I mean, it comes down to Germany. What does Germany want?
Of course. Doesn't it always come down to Germany?
It always comes down to Germany.
They have a big club.
They have a big club. So, what do you see going on with taxes?
Yeah, it's interesting. I think some people are going to be surprised. There was a major tax change this year where all the marginal rates have gone up, and so people in the highest bracket are looking at 39.6, and then, there's long-term capital gains could be up to 20. You got this Obamacare tax everyone's talking about, another 3.8. So, I think what we're seeing for clients is the conversation we're having year-end tax planning is there anything I can do to manage brackets? Keep me in the lower brackets.
Correct.
And
postpone
gains
which is, or whatever.
Defer income and take expenses. So I think that's a lot of conversations, and we're seeing a lot of interest in cash balance retirement plans, which have been popular years ago or become popular again. It allows the older owners to put a lot of money away, and so we're seeing a lot of conversations about plan design and retirement plans.
That's really interesting. So what we're going to see is a move back towards deferring income through all sorts of retirement planning, so you don't have to pay taxes on it.
Yeah, it's funny. I mean, you're seeing that. I was at a meeting. The health insurance guy was talking about, I call the alphabet soup, the HRAs, health reimbursement accounts, the flexible spending accounts, and all opportunities to defer taxes, right? And that's what, that's now the key is like anything I can do, to save $1, not pay 40% tax on it, I'm going to try to do, So it'll be interesting. I know there's talk about some, corporate tax reform. I don't know if we'll get any or not, but I think a lot of the small businesses or LLCs and partnerships hitting the
it goes right into their personal income tax.
So,
there's no there's no like corporation in between.
Yeah, so corporate reform does nothing for that small business, which we are all part of.
We're
small
all part
businesses,
of, right?
So it'll be interesting. I don't know if they'll get anything done tax wise. It'll be an interesting question for our guest since he's a tax expert as well. But we'll see what happens.
So, yeah, we'll see what happens. But what are your thoughts on taxes over the next few years?
Do I think they're going up or down? So
simple question.
Yeah, You know what? I don't know if they can get anything done in this the gridlock we have in government. I mean, I think there's a hard argument they should lower taxes across the board. If they really want to help create jobs and fix the economy, I'm a proponent of reduced taxes. But unfortunately, there's a half of politicians feel the other way, right? So, what do you think? What do you think is going to happen?
Well, I think if the current spending in Congress is ultimately not addressed, and by the way, that means addressing the entitlement programs.
Right.
Taxes are going to have to go up and go up significantly. Because if you look at the ratio of entitlement spend to what we would call discretionary spending, it's now at 2.5 to 1, up from 1 to 1 30 years ago. And by the end of this decade, it's going to be 4 to 1. So, and it's going to go above that. So if they don't do something to rein in what is the spending on Social Security, Medicare, Medicaid, et cetera, what you're going to see is this explosion in social programs that are going to basically leave no money to even pave a road.
Right.
So you're going to need at some point to raise taxes, either raise taxes significantly to pay for that, or you're going to need to cut them back.
You think we'll get to a point where they means test Social Security?
Absolutely.
Sooner rather than later?
Sooner than later.
Yeah, I mean, it has to happen.
And possibly in the next administration.
Yeah.
Whoever that is, whether it's Republican or Democrat, they may not have a choice.
Yeah. Makes sense.
All right, well, we've barely gotten through anything, and it's time for our question. Our question tonight comes from Todd Reed from Exton, PA, and his question is commercial real estate a good investment as opposed to the increase in internet stores?
So I love commercial real estate. I think it's a great investment. As they say, location, location, location.
Right.
I guess the question about the internet stores is, is there a risk that we're having less bricks and mortars and, everything's been done online? But there's a ton of businesses that aren't just retail that need commercial real estate. Your business needs one, mine, doctors, right? So, yeah, I think, am I looking to buy a strip mall, with some anchors? I don't know if they're the greatest investments, but I love commercial real estate. Great cash flow, it builds wealth, so I'm a big fan of it. So.
Yeah, I would agree. Commercial real estate is a good investment over the long term, and I mean over the long term. Right. It's not a 2-year investment, it's a 10 to 20-year investment.
Yeah.
And you can build tremendous wealth. And if, as we've discussed in prior shows, there's actually inflation because of all the money the Federal Reserve has created, then owning hard assets would be a very good investment.
Yeah, right. Yeah, I think people confuse real estate with a flip. Or, we're talking about income-producing rental streams in the future.
Correct.
Right. So.
Yeah. But if you would like to have us ask your question on the show, please write to Money Matters, 205 East Levering Mill Road, Bala Cynwyd, PA 19004, or email us at moneymatterstv@gmail.com. And now it's time for our guest tonight. Good evening, Peter.
Good evening. Thank you for having me tonight.
Well, we're glad to have you. You're an independent wealth advisor. Maybe you could tell us a little bit about what you mean by wealth advisor, what you mean by independent, and what you do for your clients.
3 good questions. As a wealth advisor, what I do for my clients is help them protect their assets, protect their wealth, and protect their generational succession. What I do for my clients, and I don't know if it's able to be picked up from here, we'll show it a little bit later, is I approach their investments and their wealth from what I call the personal wealth spectrum. And so what that is it's taking an approach of risk mitigation that then looks across generations. Let's see if they can zoom in for just a minute on this. And when I say it's independent, what we're doing is I don't receive compensation for investments. I leave it to experts like yourself. What I'm looking to do is advise the clients and help them identify the different components of their wealth world. What does that mean? At one end of the spectrum, you're looking at things like estate planning and financial planning, which is more the all-encompassing. At the other end of the spectrum is what I call the quick speed bumps, long-term care planning, disability, and of course the one that really is the wild card for everybody these days is what is the impact of health care on the financial world? What's Obamacare and what does it mean?
So many people, when you think about wealth spectrum, focus on the investments, and you probably see this. A lot of those areas never get touched, or they don't never get integrated. So how do you get involved in a relationship? Clients come to you, why? Because they're concerned about something?
They'll originate from 2 or 3 sources. One of the sources they'll come to me through an investment advisor like yourself, because you're looking out for some of the specific needs, but then want to help them look at the bigger picture. And you may have those services and those expertise within your shop. Other people will come to me directly because they may not be completely happy with their investment advisor or their bank or financial institution, and they say, Peter, who's looking at the big picture for me? And so what I like to do is to partner with and be what I call the bench strength for insurance advisors, investment advisors, or be the super associate for the law firm or the local investment firm, because my background started as a CPA, went back to law school, got my LLM in taxation, and then finished off with icing on the cake as a CFP, so that I have a little bit of knowledge in each of these areas. Not that I'm going to be the expert, but to be the person that can find out and be able to identify, for example, what are you doing about your 25-year-old daughter who may have $100,000 of educational debt? Is that something that your retirement plan can handle? Because if she can't pay it, you're going to have
moving back home.
And
right?
moving back home.
Right. And moving back home, it's the people who are between 45 and 65 are really, you've probably heard this term, the sandwich generation. They're having to take care of their parents and then also hopefully not have to take care of their children as much. But that's how those things come about. Part of the area where new clients come to me, a lot of it has to do with social media. I use LinkedIn pretty extensively and run a discussion group on that medium that has been very successful of attracting clients and attracting professional interest.
So, Peter, you briefly showed people your personal wealth spectrum there. Maybe you could walk people through the different components of that and why those components make up the personal wealth spectrum.
So the first part of looking at the wealth spectrum is to look at it across generations, meaning people refer to G1, G2, G3, G4, which would be the grandparents, the parents, the children, and the grandchildren. Any financial aspect and all financial input items will impact one of those generations at some time, often multiple at the same time. So you also then have, across the spectrum, you have some of the detail that goes from healthcare, disability, life insurance, long-term care, investments, retirement. So you have each one of those buttons or components that by themselves, if they're not attended to, can really have a detrimental impact. What does that mean? In a nutshell, what it means is my focus for my clients and what I try to input upon advisors is risk mitigation. What do you do to mitigate the risk? And this folds very well into investment portfolios and investment theory approach, which says, and you've probably had this conversation with your clients, is you can do more for them by protecting the downside risk in a bad economy than try to chase double-digit returns. And so if I can help identify a risk. The 70-year-old grandmother who has a $4 million portfolio. Well, has she taken a look at what her children and grandchildren are doing? Mm-hmm. In our world, I'm 53, my parents didn't pay attention or didn't put their nose in my business. But we need to put our nose into our children and grandchildren's business a little bit so that we can make sure we're protecting them and also self-centeredly protecting ourselves.
Yeah, and that's a good point. I mean, one question we ask clients is who you're responsible for, right? And once they start thinking about it, it's it's not just each other, right? It's the kids and grandkids and parents, as you said. So
and a fun story. I like to use stories a lot. I like to use analogies, and all of us have gotten on a plane at one point in time, and they go through the risk of telling you what happens, and if you sit in the exit aisle, are you able to perform the duties? And so one of the questions or pieces they always say is, if there's decompression in the cabin, what do? You put the mask on yourself first. Why? Save yourself, you can save your family. If you don't save yourself, you can't save your family.
Correct.
And so if you take that and apply it, save yourself, save your children, save your grandchildren. Expand that to save yourself, you can save a philanthropic organization, help cure a disease. I mean, to me, that's the fun part of this, is by helping people grow and amass and protect wealth. Earlier, you were talking in your discussion about, will they raise taxes? What are they going to do? The piece that we work with clients on is to say they may or may not raise taxes, but what are you doing to protect those assets that have made it past the income tax? Mm-hmm. The next generation. Will we be able to do it? Don't know, but at least we want to mitigate those risks that are out there all the time.
What do you think the biggest risk you see that goes ignored or not properly dealt with?
I think the biggest risk I see is lack of education. People don't spend the time, because we're in a very time-compressed world. Think of it when we meet with clients. They're between meetings, they have to go someplace. If people could take an extra 10 minutes, 15 minutes, an extra hour, and educate themselves through their advisors, the biggest risk I see is people going through and not being educated and saying, well, nobody told me about that. And the classic example I use is a couple that are in their 50s, they have a daughter. I use daughters all the time because I have a 9th grade daughter, so everything hits home. And when she turns 32 and is finally allowed to get married, so the daughter gets married and they buy a house. Well, if they're not protected, and some of it can be as simple as a 10-year term policy or something that they're not protected, if something happens to the wife or the husband, then one or both of them are now going to become my responsibility, because I'm not going to kick them to the curb. And so at age 70, do I want to be supporting a family and grandchildren? I would do it in a minute if I had to, but I would like to do it so that they are protected against themselves. So education really is the piece that I try to focus. How a client pays for that, that's a separate issue, which is probably one of the things that people, how do you get paid, or how does all this work? Some clients hire me on a retainer basis. Some of them it's products and services. I like to say I spend 50% of my time in a fee-based world, 50% in a product world, and the other 50% is more in the consultative world.
And I think it's key. Everyone's getting paid. It's just how they get paid, right? Because there's this concept, some stuff's free, right? And
I'll have that conversation. I have a client down in Florida that I'm working with. It's a 90-year-old couple that I've been hired and taken on because of their children. And so everybody gets paid. It's a question of where is it coming from? And that's part of it, is where the independence comes in, because if you're working with other advisors, it's forcing you to come clean.
Right.
And say, you can pay me an hourly rate, or you can pay me through a product or service. And if it's a 10-year term policy on your 25-year-old daughter, trust me, there's not a lot of money in that. But at the same time, that's usually the reason why it's overlooked.
Right.
Because many advisors,
It's not worth the
It's
bother.
not worth
Yeah, right.
the time or trouble to put the policy in place because they don't get a big enough commission.
thank you for eloquently putting it that way. But
Well, that's the truth.
That's what it comes down to. There's a bottom line in here, and this is a business. And the reason why I'll pay attention to the little things with the clients is I would rather not have to look for new ones.
Right.
And this is what I try to tell advisors in matching up and partnering with them is I say, how do you want to protect your runoff?
Yeah.
Well, that's what it is.
That's what it is. And if your assets under management aren't protected, if you don't have the right estate planning in place so that when grandpa passes on, half of it's going to Uncle Sam, it's asking those questions and challenging people in a way. The part that's nice about it is when I take the risk mitigation approach, you're always finding surprises that people didn't know about. And they're like, I'm thankful we had this conversation, Peter, because I didn't realize that that was a problem. Why didn't my previous advisor tell me that? Don't know, wasn't there, let's not worry about the past. Let's draw a line and move forward and say, how can we create value?
So we've talked about the downside protection. What are you telling people on the investment management side, or do you just totally outsource that?
I outsource it with a caveat.
Okay.
I don't want to be in a position of not putting some ideas into their mind and into their approach. What I'll do is I will sit on the client side, so I'm their board member. And so what I tell them on the investment front is if it's a trust, it's got a different fiduciary outcome than if it's private money because there's a generational piece to that. What I'll tell them on the investment side is what keeps you up at night and what are you most worried about? And I think the two of you would probably very familiar. I refer to it as the behavioral finance approach to investing. Some people like it, some don't. But if you like having $1 million in the bank and you have $4 million invested and that $1 million uninvested in cash makes you feel good and it helps you so that you're not worried about what's going to happen if the economy and the market goes south, that's okay. As long as the numbers work and that you can provide for these future speed bumps. But I really try to keep it more towards the investment professionals like yourself because you're in it day in and day out. You're dealing with disclosures with the SEC. You're dealing with all those things. It's enough of a challenge for me to try to pull all the stories out of the family on why Aunt Frida does what she does and why it's an impact on Uncle Fred. So those are the two.
And we have time for just one last brief question. What are your clients concerned most about today?
The biggest concern they have is uncertainty, and I like to refer to it as the sacrament of letting go. They really are concerned about all the chaos that's going on. Is it Obamacare? Is it Congress? Is it a shutdown? And sometimes what I tell them to do is, if their financial picture is adequate, my best advice to them is to turn off the TV.
We don't watch too much TV in our house. Is Diane James. She's Executive Director of the Greater Philadelphia Executives Group. And from us here at Money Matters TV, your money matters.